Global war risk is rising. Military tensions are escalating across multiple regions of the world. Defense budgets are climbing at a pace we haven't seen in decades. Governments are strengthening alliances, building strategic reserves, and quietly preparing for a much more uncertain geopolitical environment. And yet, if you look at financial markets today, you might not think anything unusual is happening. Stock markets are still trading near record highs. Investors remain focused on inflation numbers, economic data, and the next interest rate decision from the Federal Reserve. But beneath the surface, something very different may be unfolding. Central banks around the world are buying gold at one of the fastest rates in modern history. Military spending is surging globally. Strategic competition between major powers is intensifying. And historically, when these kinds of conditions appear at the same time, one asset has often emerged as one of the biggest winners: gold. So the real question investors are starting to ask is this: if geopolitical tensions continue rising across the world, could gold be entering the early stages of a powerful new bull market? Because when global uncertainty increases, financial markets tend to change their behavior. Investors stop focusing only on growth. They begin focusing on protection. And for thousands of years, one asset has consistently played that role: gold. The world is entering a new geopolitical phase. For much of the past 30 years, the global economy operated under what many analysts call the era of globalization. Trade expanded rapidly. Supply chains became deeply interconnected. Manufacturing spread across continents. Capital flowed freely between financial markets. And although regional conflicts still occurred, the general trend was toward economic integration and cooperation between nations. But over the past decade, that environment has begun to change. Strategic competition between major powers has intensified. Trade disputes have become more frequent. Energy security has become a national priority. Supply chains are being redesigned to reduce dependence on geopolitical rivals. And governments around the world are dramatically increasing defense spending. When countries begin prioritizing military readiness, strategic resources, and energy independence, it usually signals something important. They are preparing for uncertainty. And when governments prepare for uncertainty, investors eventually start preparing as well. But here's something many investors forget. Gold's relationship with geopolitical instability is not a modern phenomenon. It's a pattern that has repeated again and again throughout history. Gold's role. During periods of conflict, gold has held a unique place in human civilization for thousands of years. Long before modern financial systems existed, gold was widely recognized as a store of value. Ancient empires used gold coins to conduct trade. Kings stored gold in royal treasuries. Merchants relied on gold to settle international transactions. And although financial systems have evolved dramatically since then, gold's reputation as a reliable store of wealth has remained remarkably consistent. Empires have collapsed, currencies have been replaced, economic systems have transformed, but gold has retained value across centuries. That historical legacy still influences how investors think about gold today. During stable economic periods, investors typically prefer assets that generate income. Stocks provide dividends and capital growth. Bonds offer interest payments. Real estate produces rental income. But when uncertainty rises, especially geopolitical uncertainty, priorities change. Instead of focusing purely on maximizing returns, investors begin focusing on protecting wealth, and that's when gold tends to attract renewed attention. Why gold is considered a safe haven. In modern financial markets, gold is often described as a safe haven asset. This term refers to investments that historically hold value or perform well during periods of economic or geopolitical stress. Gold qualifies for this role for several reasons. First, gold is a physical asset. Unlike fiat currencies, it cannot be created by central banks. Unlike stocks, its value does not depend on corporate profits. Unlike bonds, it does not rely on borrowers repaying debt. Gold simply exists. Its supply grows slowly through mining, and its value is determined primarily by supply, demand, and investor confidence. Second, gold is globally recognized. Across cultures and financial systems, gold has been accepted as a store of wealth. This universal recognition makes it unique compared to many financial assets. Third, gold historically performs well during specific types of crises: periods of high inflation, currency instability, geopolitical conflict, financial system stress. During these moments, investors often seek assets that exist outside traditional financial systems, and gold fits that role. But private investors aren't the only ones buying gold. Some of the biggest buyers in the gold market today are actually governments themselves. One of the most important trends shaping the gold market today is the behavior of central banks. Central banks manage national monetary policy and hold foreign reserves designed to stabilize their economies. These reserves are typically diversified across several asset classes, including government bonds, foreign currencies, and gold. But over the past several years, central banks around the world have been significantly increasing their gold reserves. Institutions like the People's Bank of China, the Reserve Bank of India, and the Central Bank of Turkey have all been adding gold to their holdings. Why would central banks increase gold reserves? There are several reasons. One reason is diversification. Holding gold reduces reliance on any single currency. Another reason involves geopolitical risk. Gold is one of the few reserve assets that cannot easily be frozen, restricted, or controlled by another government. In an era where financial sanctions are increasingly used as geopolitical tools, this characteristic becomes extremely important. For many countries, holding gold is a way to maintain financial independence. But central bank demand is only one part of the story. Another powerful force shaping the gold market is inflation. And that brings us to something history has shown repeatedly. Wars are extremely expensive. War, government spending, and inflation, large-scale conflicts require enormous financial resources. Governments must fund military operations, produce equipment, maintain troops, and support wartime economies. Historically, governments have financed wars through three primary methods: raising taxes, borrowing money, or expanding the money supply. Each of these strategies can have significant economic consequences. Borrowing increases national debt. Money creation can lead to inflation. And inflation reduces the purchasing power of paper currencies. This dynamic has occurred repeatedly throughout history. And when investors begin worrying about the long-term value of currencies, they often start looking for assets that historically preserve purchasing power. Gold has long been viewed as one of those assets: war risk in commodity markets. When geopolitical tensions escalate, one of the first places financial markets react is in the commodity sector. Commodities are the raw materials that power the global economy. Oil fuels transportation and industry. Natural gas heats homes and generates electricity. Industrial metals support manufacturing and infrastructure. And precious metals like gold and silver play critical roles in both industry and finance. Because commodities are tied directly to the physical world, they tend to respond quickly when geopolitical risk rises. Conflicts can disrupt supply chains. They can threaten transportation routes. They can affect mining operations, shipping lanes, and energy infrastructure. And when supply becomes uncertain, prices often rise. One of the most sensitive commodities to geopolitical risk is oil. Energy markets are deeply intertwined with global politics, and even the possibility of disruptions can send prices higher. But here's where things become especially important. Some of the most critical energy routes in the world pass through extremely sensitive geopolitical regions. The strategic importance of global energy. Choke points. Around the world, several narrow shipping routes play an outsized role in global energy supply. These areas are known as strategic choke points. One of the most important of these locations is the Strait of Hormuz. This narrow waterway connects the Persian Gulf to the open ocean. And every day, a massive portion of the world's oil supply passes through it. Estimates suggest that roughly 1/5 of global oil consumption moves through this single shipping route. That means any disruption in this region could have immediate consequences for energy markets. If geopolitical tensions threaten shipping traffic through the Strait of Hormuz, oil prices can rise very quickly. But oil isn't the only commodity affected by geopolitical tensions. Gold often responds as well, sometimes even faster. Why gold reacts to energy shocks, energy price spikes, can ripple throughout the entire global economy. When oil becomes more expensive, transportation costs rise, manufacturing costs increase, food production becomes more expensive, and inflation pressures begin to build. Inflation erodes the purchasing power of currencies. When investors start worrying about inflation, they often begin looking for assets that historically maintain value. Gold is one of those assets. This is why energy crises and gold rallies often appear around the same time. Energy shocks can trigger inflation. Inflation can weaken confidence in currencies. And weakened confidence in currencies can push investors toward hard assets, including gold. But inflation isn't the only reason investors turn to gold during geopolitical crises. There's another powerful force at work: currency stability, currency risk. During global conflict, modern financial systems rely heavily on confidence. Currencies have value because people trust that governments and central banks will maintain their stability. But during major geopolitical conflicts, that confidence can sometimes weaken. Governments may increase spending dramatically. National debt may surge. Central banks may adjust monetary policy to support economic stability. All of these actions can influence currency values. And when investors become concerned about the long-term stability of currencies, they often begin diversifying their assets. Gold plays a unique role in this process. Unlike fiat currencies, gold is not issued by any government. It cannot be devalued through monetary policy. And it is recognized globally as a store of wealth. This makes gold particularly attractive during periods of geopolitical uncertainty. Institutional investors, and gold another critical force shaping gold markets today, is the behavior of institutional investors. These investors include pension funds, hedge funds, sovereign wealth funds, and large asset managers. Together, they control trillions of dollars in capital. When these institutions adjust their portfolios, even small changes can influence markets. Gold is often included in institutional portfolios as a hedging asset. A hedge is an investment designed to reduce risk. For example, if investors believe geopolitical tensions could destabilize financial markets, they may increase allocations to assets that historically perform well during crises. Gold often fits that role. If large institutional investors begin increasing gold exposure at the same time, demand can rise rapidly. And because the gold market is relatively small compared to global stock and bond markets, these flows can move prices significantly. But here's something that surprises many people. Gold often begins rising before major crises fully unfold. Financial markets are not just reflections of current events, they are also predictions about the future. Investors constantly analyze trends, data, and geopolitical developments in an attempt to anticipate what might happen next. Gold markets are particularly sensitive to changes in global risk perception. If investors begin believing that geopolitical tensions could escalate, they may start buying gold before the full economic consequences become visible. This forward-looking behavior can push gold prices higher, even when the broader economy still appears stable. That's one reason analysts pay close attention to geopolitical developments when evaluating gold trends, because gold sometimes begins reacting earlier than other markets. Quick pause for a moment. If you're interested in understanding how geopolitics, commodities, and financial markets intersect, consider subscribing. This channel focuses on deep dive analysis into gold, oil, silver, and global macroeconomic trends, especially how they impact investors in the United States. Now let's continue. Beyond economics and geopolitics, gold also plays a psychological role in financial markets. Investors often associate gold with stability. During periods of calm markets, this perception may not matter much. But during periods of uncertainty, investor psychology becomes extremely important. Fear and uncertainty can drive rapid shifts in investment behavior. Assets that are perceived as safe often attract significant capital during these moments. Gold's long history as a store of value reinforces its reputation as a financial safe haven. Even investors who rarely think about gold during normal times may begin considering it when global risks rise. But to fully understand why gold could become a major beneficiary of rising war risk, we need to examine something else: history. Because history shows a fascinating pattern between geopolitical crises and gold prices. Throughout modern history, gold has often performed strongly during periods of geopolitical instability. One of the most dramatic examples occurred during the 1979 oil crisis. During that period, geopolitical tensions in the Middle East disrupted global oil supplies. Energy prices surged, inflation accelerated across major economies, and gold prices rose dramatically. Another major example occurred during the 2008 financial crisis. While this crisis was primarily financial rather than geopolitical, it still triggered massive uncertainty across global markets. Investors worried about banking stability, economic recession, and currency risks. Once again, gold attracted significant demand. These historical examples demonstrate how gold can benefit when uncertainty spreads through financial systems. To understand why analysts are increasingly paying attention to gold, we also need to look at a major global trend that has been accelerating quietly over the past decade. Military spending is rising worldwide. According to data from the Stockholm International Peace Research Institute, global defense spending has reached record levels in recent years. Countries across Europe, Asia, and the Middle East are dramatically increasing military budgets. Governments are investing in advanced missile systems, cybersecurity capabilities, artificial intelligence, and next-generation military technologies. The North Atlantic Treaty Organization has encouraged member countries to increase defense spending to at least 2% of GDP. Several countries are now exceeding that level. Why does this matter for investors? Because rising military spending often signals a shift in geopolitical priorities. When nations allocate more resources toward defense, it usually means they are preparing for a more uncertain strategic environment. And historically, when geopolitical uncertainty rises globally, financial markets eventually reflect that risk. But here's something that surprises many investors. Geopolitical risk doesn't always trigger immediate market panic. Sometimes the biggest moves happen when markets are still calm. Financial markets tend to focus heavily on economic indicators, interest rates, inflation data, corporate earnings, employment numbers. These metrics are extremely important for understanding the health of an economy. But geopolitical risks are much harder to quantify. Conflicts rarely follow predictable timelines. Tensions can build slowly over years and then escalate suddenly. This unpredictability makes geopolitical risks difficult for markets to price accurately. As a result, markets sometimes underestimate these risks until a major event occurs. And when that happens, asset prices can adjust very quickly. Gold often reacts strongly during those moments. The debt factor. Another important piece of the puzzle involves government debt. Over the past 2 decades, global debt levels have increased significantly. Governments borrowed heavily to stabilize economies during the 2008 financial crisis, and borrowing increased again during the COVID-19 pandemic economic crisis. Today, many major economies are operating with historically high debt levels. High debt creates difficult policy choices. Raising taxes too aggressively can slow economic growth. Cutting spending can be politically challenging, and high interest rates make debt more expensive to service. Because of these pressures, some analysts believe governments may rely on moderate inflation over time to gradually reduce the real burden of debt. This dynamic is sometimes referred to as financial repression. In environments where inflation remains elevated while interest rates stay relatively low, real interest rates can become negative. And historically, gold has tended to perform well during periods of negative real interest rates. But inflation isn't the only factor analysts are watching. Another key variable influencing gold markets is monetary policy. Interest rates in gold does not produce income. It does not pay dividends like stocks. It does not generate interest like bonds. Because of this, interest rates play an important role in gold pricing. When interest rates rise significantly, income-producing assets can become more attractive relative to gold. But when interest rates fall, or when inflation rises faster than interest rates, gold becomes more competitive as an investment. This is why analysts closely watch policy decisions from the Federal Reserve. Changes in interest rate expectations can influence the direction of gold markets. For example, if investors believe central banks will eventually reduce interest rates to support economic growth, gold demand may increase. Lower rates can weaken currencies and make gold more attractive as a store of value. Several large financial institutions have recently outlined bullish long-term scenarios for gold. Analysts at banks such as Goldman Sachs and JPMorgan Chase have discussed the possibility of higher gold prices in environments characterized by persistent inflation, geopolitical instability, strong central bank demand, and lower real interest rates. None of these factors alone guarantees higher gold prices. But when several of them appear simultaneously, they can create powerful upward pressure on the gold market. This is why analysts often refer to gold as a macro asset. Its price is influenced not just by supply and demand, but by the broader economic and geopolitical environment. But here's where things get really interesting. Because when analysts talk about the future of gold, some projections are far higher than many investors expect. The $3,000 to $5,000 gold debate. In recent years, several market analysts have begun discussing the possibility that gold could eventually reach much higher price levels. Some projections suggest potential scenarios where gold could reach $3,000 per ounce or higher over the long term. A few more aggressive forecasts have even suggested the possibility of $5,000 gold under certain macroeconomic conditions. These projections are based on several factors. First, global debt levels are historically high. Second, central banks are accumulating gold reserves at an accelerated pace. Third, geopolitical competition between major powers appears to be intensifying. And fourth, the global financial system continues to evolve as countries explore alternatives to traditional reserve currencies. Again, these scenarios are not guarantees. Financial markets are complex, and many factors influence asset prices. But the fact that such projections are being discussed illustrates how dramatically the macroeconomic environment has shifted. The supply side of gold. Another important aspect of the gold market involves supply. Gold production grows slowly over time. Mining companies must locate deposits, secure permits, and invest heavily in infrastructure before new mines can begin operating. This process often takes many years. As a result, the supply of newly mined gold typically increases only gradually. Meanwhile, demand can change much more quickly. If central banks, institutional investors, and private investors all begin increasing gold allocations at the same time, demand could rise faster than supply. When that happens, prices may move upward to balance the market. But gold is not the only precious metal affected by geopolitical risk. Silver often moves alongside gold, or sometimes even more dramatically. Silver's unique position. Silver is both a precious metal and an industrial metal. It is widely used in electronics, solar panels, and advanced manufacturing technologies. This dual role creates an interesting dynamic. During periods of economic growth, industrial demand can support silver prices. During periods of financial uncertainty, investment demand can increase as investors seek precious metals. Because silver markets are smaller than gold markets, price movements can sometimes be more volatile. This volatility is one reason some investors view silver as a higher risk, higher reward version of gold. And when geopolitical tensions rise, both metals often attract attention from investors seeking protection. Central banks and the new gold strategy. One of the most important developments in the gold market today isn't coming from individual investors. It's coming from governments. Over the past several years, central banks around the world have been increasing their gold reserves at a pace not seen in decades. According to data from the World Gold Council, central bank gold purchases have reached some of the highest levels in modern history. Why are central banks buying so much gold? There are several reasons. First, diversification. For decades, many countries have held a large portion of their foreign reserves in US dollar assets, particularly US Treasury bonds. But in an era of rising geopolitical tension, some countries want to reduce their reliance on any single currency. Gold provides an alternative reserve asset that is not controlled by any government. Second, geopolitical security. Unlike foreign currency reserves, physical gold stored domestically cannot be frozen or restricted by another country. This characteristic has become increasingly important as financial sanctions have become more common in international politics. And third, long-term stability. Gold has served as a monetary asset for thousands of years. While currencies can change, gold tends to retain value over long periods of time. For central banks thinking in decades rather than months, that stability can be very attractive. But central banks accumulating gold may also be telling us something else. Something about the future of the global financial system itself. The changing global monetary landscape. For most of the past century, the international financial system has revolved around the US dollar. After the Bretton Woods Agreement in 1944, the dollar became the foundation of the global monetary system. Even after the gold standard ended in 1971, the dollar remained the dominant currency used in global trade and financial markets. Today, commodities like oil are typically priced in dollars. International loans are often denominated in dollars, and central banks hold large amounts of dollar-based assets as reserves. However, geopolitical competition is beginning to reshape parts of this system. Some countries are exploring ways to reduce reliance on the dollar for trade and financial transactions. This process is often described as reserve diversification. Gold plays a natural role in this shift because, unlike national currencies, gold is politically neutral. It does not belong to any one country. It cannot be printed by central banks. And it has historically functioned as a universal store of value. For countries seeking greater financial independence, gold provides a logical reserve asset, the energy, geopolitics, gold triangle. Another major force linking geopolitics and gold involves energy markets. Energy remains one of the most strategically important sectors of the global economy. Oil and natural gas power transportation, manufacturing, agriculture, and electricity generation. And when geopolitical tensions threaten energy supply, the effects can ripple across the entire world economy. Consider what happens when oil prices surge. Transportation costs rise, food prices increase, manufacturing expenses climb, inflation pressures spread through the economy. And as inflation rises, investors begin searching for assets that preserve purchasing power. Gold historically performs well in these environments. This relationship between energy markets and gold is one reason analysts watch geopolitical developments in energy-producing regions so closely, because energy disruptions often lead to broader economic consequences. But despite all these factors, rising geopolitical tension, central bank gold purchases, and inflation risks, many investors are still underexposed to gold, and that creates an interesting dynamic. So let's step back and look at the big picture. Global war risk is rising, defense spending is increasing, geopolitical alliances are shifting, central banks are accumulating gold, and investors are becoming more aware of macroeconomic risks. None of these trends guarantee that gold prices will skyrocket tomorrow. Markets are complex, and many factors influence price movements. But history has shown that during periods of geopolitical uncertainty, inflation concerns, and financial instability, gold often becomes one of the most closely watched assets in the world. Because when uncertainty spreads across the global economy, investors begin searching for stability, and for thousands of years, gold has played that role. So here's the big question. If geopolitical tensions continue rising over the next decade, could gold become one of the most important assets in the global financial system once again? Or will modern financial markets behave differently this time? Let me know what you think in the comments. And if you enjoy deep dives into gold, oil, geopolitics, and global financial markets, make sure to subscribe, because the forces shaping the global economy right now could define the next major investment cycle. Thanks for watching, and I'll see you in the next video.